Welcome back. In this lecture, we're examining the controls and the auditor response to the revenue cycle. If you took the Advanced Accounting Information Systems and Data Analytics class, then you examined the controls from the accounting information system perspective. Now we're flipping the coin and examining the revenue cycle from the auditor's perspective. In the system design phase, you're identifying what controls should be in place to prevent bad stuff from happening. In the audit phase, you're testing the sufficiency of those controls and testing the numbers that make up the account balances so that you can verify those balances. Let's get started. So let's start by way of a little bit of a review. Underlying all of the activities in the entity and in the revenue cycle in particular is the control environment, that is, the tone at the top. While this isn't directly related to the activities of the revenue cycle, it is of fundamental importance because if management commits to being ethical, if management commits to implementing internal controls and disseminating information top down, bottoms up about the necessity of those controls, you can better trust the other control activities within the organization. Control activities, as we've discussed, are the people and processes that serve to promote the control objectives, so the operational objectives, the reporting objectives, and the compliance objectives. In other words, preventing stealing, lying, and cheating. And from a financial reporting perspective, preventing and/or detecting fraud and/or error. The auditor's role in providing assurance over the reporting and the internal controls over financial reporting is to understand the control system, to perform tests of design and tests of effectiveness with regard to the controls, and to perform audit tests based on the assessed risk and the sufficiency of the control structure. Depending on both of those factors, the auditor will adjust the nature, extent, and timing of the audit procedures. So in this particular unit, we're looking at the revenue cycle, which involves receiving orders, managing customer credit, delivering the product to the customer, and billing and collections. We're covering this one because revenue and receivables are high risk. They're used in other functions like analysts predicting stock and firm performance, and they're subject to manipulation. There's a number of controls that relate to the different activities that we just saw from the revenue cycle. With regard to placing orders, some controls include using sequentially numbered purchasing orders, embedding controls within the accounting information system, and using access controls for the price list. With regard to managing customer credit, some of the controls include establishing access controls and limiting access to purchase authorizations, purchase limits, and additions and changes. With regard to delivering the product, limiting the physical access to inventory and shipping areas, and using sequentially numbered shipping and transfer forms. And with billing and collections, access controls, frequency of backups, and reconciliations. This is just a sampling of the control activities in the revenue cycle. Because this is such an inherently risky activity, you can usually expect the controls to be quite robust in this area. But because it is an inherently risky activity, it's one that requires a significant amount of testing. The audit function, again, exists to understand those controls, to evaluate those controls, and then perform test work based on the effectiveness of those controls and their overall risk framework. auditors assess risk for each significant account and each of the relevant assertions. We've discussed since Chapter 1 the relevant assertions: completeness, cutoff, valuation, existence and occurrence, rights and obligations, and the understandability and classifications of reports. A significant account is one that is susceptible to misstatement via fraud or error. Now, with the revenue processes, an auditor assesses risk with regard to completeness, occurrence, and the cutoff date. With regard to receivables, the auditor assesses risks related to completeness, valuation, existence and occurrence, and to some extent, rights and obligations. We'll talk about this in a little bit more depth later. Now let's apply the relevant assertions related to the revenue cycle with the CPA exam question. An auditor's purpose, An auditor's purpose in reviewing credit ratings of customers with delinquent accounts receivable is most likely conducted to obtain evidence concerning which of the following management assertions. And I'll give you a couple of seconds to read through and select your answer. Got an idea? The correct answer is A, valuation and allocation. These assertions deal with whether asset, liability, revenue, and expense components have been included in the financial statements at appropriate amounts, and with any resulting valuation adjustments being properly recorded. By verifying the credit ratings and the delinquent accounts receivable, the auditor is trying to get a good idea of how big and how broad the allowance for doubtful accounts should be. So that impacts valuation. Let's look at the other answers. Item B, assertions about understandability and classification deal with the financial reporting, whether the financial information is appropriately presented and described, and whether disclosures are clearly expressed. Item C, existence deals with whether assets, liabilities, and equity interests of the entity exist at a given date. Reviewing credit ratings of delinquent customers doesn't provide evidence about this type of assertion. And finally, D, assertions about rights and obligations deal with whether assets are the rights of the entity and whether liabilities are the obligations of the entity. Reviewing credit ratings of delinquent customers doesn't help evaluate the evidence about this type of assertion. So audit risk is really the concept that starts to bring the whole function of the audit together. Audit risk is the risk that auditors will issue an unqualified opinion on financial statements that are wrong, on financial statements that contain a material misstatement. Numerically, audit risk is the risk of material misstatement multiplied by detection risk. Auditors want this audit risk to be low as possible, in fact. For that to be true, risk of material misstatement and detection risk have to be inverses of each other. And that's just given the multiplicative process. So let's look at each of those components. Detection risk is the risk that an audit team's substantive procedures are not enough to detect a material misstatement. Risk of material misstatement has two components: inherent risk and control risk. Inherent risk is an account with a high susceptibility for misstatement, something that's risky just because it is. The revenue account is an example of this. Control risk is a measure of how likely controls are to prevent or detect a misstatement. Now, as the risk of material misstatement increases, so if the inherent risk is high or if the control risk is high, the detection risk decreases because bad controls mean more work. More work means less detection risk. Conversely, if the controls are strong or if the inherent risk is low, detection risk has to get increased to maintain the same level of audit risk. The auditor has to do more work to CYA. So the first step in the process is this what could go wrong analysis. With the revenue recognition process, the controls center around making sure that revenues are only recorded once the revenue generation process is complete and are only recorded once. You don't want the revenue being recorded multiple times, and you don't want the revenue being recorded before you've actually earned it. Earning activities involve producing or delivering goods or services, and the revenue is considered earned when the entity has substantially accomplished what is required to actually earn the money. With receivables, you're focusing on what could go wrong with regard to collecting the accounts receivable and how reasonable your assumptions are about collecting those receivables. You're also concerned with customer returns and allowances. From an auditor's perspective, it's easier to do your work when the return agreements are specified in the purchase agreement and they're disclosed to you. It's harder to do your work and to evaluate the assumptions when these are unknown. So the next step is performing tests of operating effectiveness. These refer to how well the controls are working. Remember, the controls include people and processes, the people doing the work and the processes that keep things in check. So if the control is operating as designed, the person performing the control has the necessary authority and qualifications to perform the control, and they're doing it the way it's designed to be completed. There's 4 different assertions with regard to the revenue process that can be tested in this phase. Completeness, so examining evidence of client review, reviewing controls surrounding different product classes and locations. Accuracy, cutoff, and classification. I've got an arrow on the slide pointing to one that could be considered a dual process test, tracing dates on shipping documents to invoice. On the one hand, this is a test of control. It should be done to prevent and mitigate the risk of material misstatement, but it's also a process that's performed evaluating the valuation assumption and the existence assumption. So now let's check your comprehension with another CPA exam question. Which of the following procedures concerning accounts receivable would an auditor most likely perform to obtain audit evidence supporting the effective operation of controls? And I'll give you a couple of seconds to read the choices and think through your answer. So, there's 2 degrees of tests that an auditor performs. Test of controls and substantive tests. Substantive tests deal with dollars. You could even think of substantive with the S with a cross through it, like a dollar sign. So any test that's designed to double and triple check numbers is a substantive test. Anything that's designed to support the effectiveness or the design of a control is a test of control. So the correct answer here is A. observing an entity's employee preparing the schedule of past due accounts receivable. That's the only choice that's strictly control related. Let's look at the other ones. Sending confirmation requests to an entity's principal customers to verify the existence of accounts receivable. We'll talk about this a little bit more in the next couple of slides, but this is a dollar confirmation. It's used partly to verify the existence, but can partially be used to verify the valuation. So that's wrong. Inspecting an entity's analysis of accounts receivable for unusual balances. This is an example of an analytical procedure, which we covered in a previous lecture, and again, which uses numbers. Unusual balances. Numbers implies substantive testing. And finally, comparing an entity's uncollectible accounts expense to actual uncollectible accounts receivable. Again, this is a dual process test because you're verifying numbers to numbers, but it also serves a function of evaluating the controls. We're looking for one that's explicitly control related, and A is the only one that fits that bill. We use analytical procedures to help in assessing the risk at the beginning of the audit, to verify the account balances at the end of the audit, and we can use them to evaluate revenues and receivables. Analytical procedures can include year-over-year trend comparisons that you would then compare potentially with the industry, financial ratio calculation, which you would then compare to both historical data and to the industry data, and the comparison of account relationships. For example, we see that this company suffered a decrease in revenue year over year from 2018 to 2019. Revenue is a driver of cost of sales. So if net revenue is lower, then we would expect cost of sales to be lower also, which it is. We would expect our net income to be lower year over year, which it is. And we would expect our finance account receivables to be lower year over year, which it is. If any of those relationships are violated, then that would be an indication of a potential misstatement or a heightened risk that we should analyze. Auditing procedures require auditors to perform account balance confirmations. These support the existence, occurrence, whatever, but they can also sort of be used to support the rights and obligations assertion as well as the valuation assertion. I say kind of because the confirmations alone are insufficient to verify full rights and obligations. For example, accounts receivable are often factored. And I say kind of with regard to valuation because they'll tell you if a balance is correct at a given time, but it's not going to tell you whether the balance is correct in totality that's reported on the financial statements. Only a customer's balance at a given point in time, but it can contribute to that. So there's two different types of confirmations, positive confirmations and negative confirmations. A positive confirmation asks the customer to confirm whether the balance is correct or incorrect. These are more common. A negative confirmation asks the customer to respond only if something is wrong with the presented balance. These are used generally when the risk of material misstatement is low. And there's a risk with using them because if a customer doesn't respond, you don't know if it's because the balance is right or because they were too busy or too hampered by other things to actually respond. Now let's apply that concept with a CPA exam question. Which of the following strategies could most likely improve the response rate of the confirmations of accounts receivable? And I'll give you a sec to take a look at that and make up a good answer. Do you have an answer? The correct response is B. Include a list of items or invoices that constitute the customer's account balances. For one, this can be more effective, especially if the balance itself is material to the financial statement. For another, customers may or may not keep track of their accounts payable by company. It's more likely that they keep track of invoices. By providing this guideline, you're helping the customer to respond accurately and effectively. Let's look at the other choices. Item A, restrict the selection of accounts to be confirmed to those customers with large balances. From a risk perspective, this is good. From a sampling perspective, it's not so good. You want to sample everybody. Furthermore, improve the likelihood of responding, reduces your risk. Item C, explain to customers that discrepancies will be investigated by an independent third party. That item will improve the quality of the responses that you receive from the customers, but not necessarily the expeditiousness. And finally, D, ask customers to respond to the confirmation request directly via fax. This is something that you should do on a second or third iteration with explicit instructions and explicitly embedded controls. It's not something you do in the offset, and it's not something you would do to respond more effectively. So the next step is to review accounts receivable for collectability. This involves the valuation assertion. The auditor tests include evaluating the adequacy of the allowance for doubtful accounts by seeing when and what cash comes in, discussing unpaid accounts with the credit manager, examining the credit files, and then using the problem customers and the customer universe to estimate likely non-payments. Compare that estimate to the client's estimation of allowance for doubtful accounts. This is an area that requires significant auditor judgment. Again, this is why accounts receivable has high inherent risk. Another audit test with regard to the accounts receivable and revenue relates to reviewing the cutoffs for sales returns. This deals with the cutoff assertion, clearly, as management can use sales returns to opportunistically impact their revenue, shifting the returns to either the prior period or the next period to make themselves look better. Cutoff tests are tests performed to ensure that sales are recorded in the proper period. These tests are performed through tracing, vouching, and reviewing and adjusting entries for cutoff errors. So to close, let's look at a couple of other substantive tests related to the revenue cycle. With regard to completeness, the auditor would want to, in addition to sampling large dollar accounts receivable, they also want to sample $0 account balances to make sure that they have, in fact, collected such revenue. The auditor also wants to verify the rights and obligations. As I stated, confirming what's owed only tells you so much about whether the company still owns the accounts receivables or whether they still owe the money to the bank. The auditor needs to inquire with management to make sure that they actually owe or own such items, and then perform additional tests to verify this. With regard to classification, the auditor needs to scan receivables for negative balances, which would indicate a reclassification of accounts receivable and be suggestive of opportunistic accounting practices. And finally, presentation and disclosure. The auditor completes a disclosure checklist to make sure that the numbers reported in the financial statements and the disclosures that support the financial statements are complete and accurate.